Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 1, and this is Section D2. This is a remembering and understanding topic. Identify the factors affecting the acceptance or continuance of an engagement, including communication with predecessor auditors. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions. If you don't know much about our strategies, make sure you go to SuperfastCPA.com and check out our free 1-hour training webinar. We go over the key ingredients to passing the CPA exam, and again, it's 1 hour. It is free, and we will show you how to pass the CPA exam without wasting months and months of your time. So make sure you check that out. After you watch the webinar, you're going to want to learn more, so make sure you check out becoming a pro member. Pro members of SuperfastCPA get access to the pro course, which is where Nate explains in detail exactly what you're supposed to be doing every single day and gives you walkthroughs of it as well. It's kind of like a more in-depth version of the webinar. And SuperfastCPA pro members get access to the full 10-question versions of these 5-question YouTube videos. So we're only going to be going over 5 questions in today's video. But remember, SuperfastCPA Pro members get access to the full 10-question versions of the videos where we go over 5 more questions, we learn a little bit more, maybe in different situations so that they can make sure that it sticks and make sure that they understand it. So if you like this and you like our other material, make sure you check out becoming a pro member, and the easiest way to do that is by checking out the webinar first. With all that, let's dive straight into the questions. All right, here we are at question 1, and one thing I want to say about this video, this is kind of a continuation or kind of something that's building off of the previous video where we talked about preconditions to accepting an audit. This is similar. We're talking about some things that would affect an auditor not wanting to accept an engagement. The preconditions not being met would be one of the things, but we're going to talk about other things in this video. So let's dive into the questions. One thing I always like to point out is a good strategy for test day. And again, this is something you want to be used to for test day, is reading the last part of the question first. It's not always super helpful. Sometimes you're still not sure what the context is after reading the last part of the question first, but very frequently you will kind of have an idea what you're dealing with just by reading the last part of the question first. I always like to bold it. So we'll read that first. And again, remember, this is a test day strategy because you're going to be seeing 50 different kinds of topics and you have no idea what you're going to be seeing. So getting that quick context, if it's there, to know what you're dealing with is extremely valuable. So you want to get into that habit, even if it doesn't always help you. So let's go ahead and do it. Which of the following is the most appropriate course of action for the auditor? Okay, let's go up to the top. An auditor is evaluating whether to accept a new engagement for a potential client. During the evaluation, the auditor learns that the client's management has a history of misstating financial information intentionally to meet loan covenants. So again, what should they do? Should they A, accept the engagement but issue a disclaimer of opinion to limit liability? Should they B, decline the engagement due to concerns about management's integrity? Should they C, accept the engagement after ensuring management signs a representation letter? Or D, accept the engagement but increase the level of substantive testing? Now, we're pretty early on in our audit journey. We haven't really talked about substantive testing. We haven't really talked about disclaimers of opinion or things like that. But overall, what do you think the auditor should do? If you have any idea, then that's great. You probably already know the answer by us going through it. But if you don't, remember, we are using these questions to learn the material. So it's okay if you don't really know what's going on. Again, we are using this to learn what we're supposed to do. So let's go ahead and dive into the explanation to start getting some background and context. All right, here we are. The answer is B. They should decline the engagement due to concerns about management integrity. So this is something that is going to affect whether an auditor accepts or declines an engagement. Let's talk about it. The integrity of management is a critical factor in deciding whether to accept or continue an engagement. A history of intentional misstatements indicates a lack of integrity, which significantly increases the risk to the auditor. Professional standards emphasize that auditors should not accept an engagement if management integrity cannot be relied upon, as this compromises the audit's credibility. So this is something that auditors have to consider before they are going to accept an engagement. If management has a history of poor integrity, then that will make the auditor much less likely to accept the engagement because the audit wouldn't be credible because they aren't going to be able to rely on the information that they audit or that they give to people when they finish the audit. So an auditor most likely would decline this situation if management has poor integrity. That's something that affects an auditor accepting an engagement. Now let's go to the next question to learn about something else. All right, here we are at question 2. Which of the following situations would most likely cause an auditor to decline an engagement? So let's go through the options. A, the client operates in an industry the auditor is unfamiliar with and requires the use of a specialist. B, management is unwilling to provide access to certain documents needed to verify material account balances. C, the client's internal controls are weak, resulting in a higher risk of material misstatement. Or D, the engagement requires significant additional staff to meet the reporting deadline. So out of all these, what is something that would cause the auditor to decline an engagement? We talked about management integrity in the first question, so which one of these looks like that would be the correct answer? A lot of times, if you read through audit, even if you don't know the answer right away, just by reading through the options, you can kind of, a lot of times, deduce what is the correct answer, or at least one or two of the options that are more likely correct than the others. So if you want to, go ahead and pause the video, kind of think through this, and when you're ready, come back, we'll look at the answer together. All right, here we are. The answer is B. Management is unwilling to provide access to certain documents needed to verify material account balances. This is something that would make the auditor not accept the engagement. So let's walk through this. An auditor must assess whether sufficient appropriate evidence can be obtained to support an opinion. If management is unwilling to provide access to critical documents, the auditor cannot perform the necessary procedures and the engagement should not be accepted. So this is kind of teaching about two different things right here. Either management not giving them information that they need could be something that prevents them from taking the engagement, or it also talks about sufficient appropriate evidence. Even if management would be willing to provide what they need, but if there wasn't enough evidence, then that would also make the auditor not want to take the engagement, because if you can't have the information you need, whether it's because management won't give it to you or because management just doesn't have it, then you shouldn't take the audit because you're not going to be able to do what the engagement requires. You shouldn't accept it. Let's talk about the other options. Option A, a lack of familiarity with an industry can be mitigated by hiring a specialist, which does not prevent engagement acceptance. It's okay if you hire a specialist to help you with something. That's not going to prevent you from taking the audit. Option C, weak internal controls increase audit risk, but do not preclude engagement acceptance. The auditor can adjust procedures accordingly. That's kind of the whole point of doing an audit, is to see if they have weak internal controls. So that's not something that's going to make you stop doing the audit, because you're supposed to be looking at internal controls and giving advice and things like that. And then option D, staffing challenges may complicate the engagement, but again, do not inherently prevent acceptance if additional resources can be secured. So even if it's going to take more than they were expecting, but they are able to do it, the auditors can take the engagement even if it would take more staff. So with all that, we learned a little bit more about what would stop somebody from taking an audit engagement. Now let's go to the next question. All right, here we are at question 3. Which of the following scenarios would most likely prevent an auditor from accepting an engagement? Okay, let's go through the options. A, the client requests that the auditor exclude a specific subsidiary from the scope of the audit. B, the client's management has not yet finalized the financial statements for the upcoming audit period. C, the client's internal controls are inadequate, requiring more extensive substantive testing. Or D, the client has a complex organizational structure that requires additional planning time. So again, out of all these, which one do you think would prevent the auditor from accepting the engagement? Now, again, if I'm being honest, just by reading through these, you probably kind of have an idea that one or two of them are more likely correct than the others. So if you need to, pause the video and think about it yourself, and when you're ready, come back, we will look at the answer together. All right, here we are at the answer. The answer is A, the client requests that the auditor exclude a specific subsidiary from the scope of the audit. So this would be something that would keep the auditor from accepting the engagement, and let's talk why. And this actually kind of builds off the previous question, so let's keep going. A scope limitation that prevents the auditor from obtaining sufficient appropriate evidence to form an opinion would preclude acceptance of the engagement. A client's request to exclude a subsidiary is an example of a limitation that could significantly impair the auditor's ability to perform the audit, making the engagement unacceptable. So basically what this question is getting at, and we kind of talked about this in the previous question too, if management is not willing to let you see certain information, whether that's they're not letting you see the information for a certain subsidiary, or they just don't want to give you certain documents that you need to be able to perform the audit, that's considered a scope limitation, and that means that you should not accept the audit, or at least you should be much more hesitant to accept the audit because they are obviously not wanting to give you information for a reason. It could be that they're hiding something, or maybe they just don't want to have a bad opinion, whatever the case may be. If they're trying to hide something from you and they have scope limitations on you, that is something that would prevent an auditor from taking an engagement. Now let's talk about the other options. Let's talk about option B. Management delays in finalizing the financial statements may cause timing issues, but do not represent a scope limitation. That's not management preventing you from being able to do your work. They're just being slow in finalizing their financial statements. Option C, inadequate internal controls increase audit risk, but again, we talked about this before, but can be addressed through additional substantive testing. Option D, a complex organizational structure requires careful planning, but does not inherently limit the audit scope. If that was the case, then a lot of big companies in the world would not be audited because they would be too difficult to audit, which of course that's not the case. So that's not something that's going to prevent auditors from accepting an engagement. So again, limiting the scope of the audit, that is something that the auditor cannot accept when they're going to think about taking an engagement. With that, let's go to the next question. All right, here we are at question 4. What should the successor auditor do next? Okay, so again, remember, if we were on test day and we saw that last sentence, what should the successor auditor do next? If you've done your homework and if you've done your studying, and you're going to learn this by doing this question with me, you will realize that we're talking about successor and predecessor auditors most likely. So that will immediately give you context for what we're dealing with. So that's again why you read that last part of the question first, because a lot of times it gives you that context. Now let's go up to the top. A successor auditor is evaluating a potential audit engagement. Before accepting the engagement, the auditor asks the client for permission to contact the predecessor auditor. The client refuses to grant consent. What should the successor auditor do next? Okay, let's talk about the options. A, accept the engagement but proceed with caution regarding management's integrity. B, decline the engagement as the refusal prevents necessary communication with the predecessor auditor. C, accept the engagement if the client agrees to provide written representations about prior audits. And D, accept the engagement and perform additional risk assessment procedures to compensate for the lack of communication. So this is the first time we're talking about predecessor auditors in this video. Just based off of the successor, predecessor, you probably can have an idea of what that is. But at any rate, if you have an idea, that's great. We're going to look at the answer in a second. If you don't really know and you kind of want to think through this, pause the video, think through the different options, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is B. They should decline the engagement as the refusal prevents necessary communication with the predecessor auditor. Okay, so we know that they should decline the engagement. Now let's learn why in the explanation. Professional standards require the successor auditor to communicate with the predecessor auditor before accepting an engagement. So this is a requirement. You have to reach out to the predecessor auditor. And let's talk about why. This communication provides critical information about management's integrity, disagreements, fraud, or other issues that may affect the decision to accept the engagement. However, the predecessor auditor must have the client's permission to share this information. So again, even though this is required, the client can say that they're not allowed to give this information. If the client refuses to grant consent, it raises significant concerns about their transparency and integrity. Without this communication, the successor auditor lacks vital information and should decline the engagement to avoid unnecessary risk. So we learned there that before an auditor starts an engagement, they have to reach out to the predecessor auditor to get some information, but the client has to give consent for that information to be given from the predecessor auditor to the successor auditor. So if the client does not give consent, kind of like the scope limitation, if they're not going to give consent, then that means they're probably trying to hide something, or they don't want the auditor to be able to see certain things. And that means the auditor should not take the engagement because that sounds pretty risky, right? Let's talk about the other options. Option A, accepting the engagement without predecessor communication is inappropriate due to the inability to assess critical risks. Option C, written representations from the client do not replace the requirement to communicate with the predecessor auditor. And option D, additional risk assessment cannot compensate for the lack of information from the predecessor auditor. So this is not something that you can compensate for if you're not given that permission. This is one of those things that if it's not given, then you just shouldn't take the audit because there's nothing you can do to kind of get around that. Now let's go to the next question. All right, here we are at question 5. When communicating with the predecessor auditor, what is the most appropriate inquiry for a successor auditor to make? Okay, so we've talked about this in the previous question a little bit, so let's read through these options and you can kind of start thinking about what you think the correct answer is. Option A, were there any significant disagreements with management over accounting policies? B, was the client's financial reporting consistent with industry standards? C, did management comply with all financial covenants in loan agreements? And D, were internal control deficiencies documented in the prior audit? So which one of these is the most appropriate thing that they're going to ask the predecessor auditor? Now, again, we kind of mentioned this in the previous question, so if you were, taking notes or things like that, then you might already know the answer. If not, that's okay. Think about this. Pause the video if you need to, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is A. Were there any significant disagreements with management over accounting policies? Okay, so we're going to talk about in this explanation what a successor auditor typically asks the predecessor auditor. So let's talk about it. A successor auditor is required to communicate with the predecessor auditor to obtain information that may influence the decision to accept the engagement. Key inquiries include significant disagreements with management regarding accounting policies or procedures, integrity of management, including any issues related to honesty or ethics, reasons for the change in auditors, including whether the termination was initiated by the auditor or the client, and then finally, knowledge of fraud, illegal acts, or internal control deficiencies identified during the prior audit. So these are the kind of things that you're going to talk about to the predecessor auditor. You're going to ask them, did management have some disagreements with you about how you were doing things? Did they have integrity? Why did they change auditors? Did they kick you out because they didn't want you to be able to find out the things that they were trying to hide? Or, whatever the case is, you ask the predecessor auditor about these things so that you have a bit more understanding and information as you go into the audit. And you can also decide whether to actually take the audit based off of talking to the predecessor auditor. Now let's talk about the other options, and then we'll be done with question 5. Option B, industry standards are relevant for planning an audit, but are not a primary focus of predecessor auditor communication. Option C, loan covenant compliance may be reviewed during the audit, but is not a required inquiry of the predecessor auditor. So that would be something that you're going to look at in the audit. That's not something that is going to stop you from being able to do the audit necessarily. And then option D, internal control deficiencies may be included in communication, but are not as critical as understanding disagreements and management integrity. And with that, we've gone over the first 5 questions, and before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up in the questions. You've seen 2, 3, 4 questions trying to teach you about what an auditor should ask a predecessor auditor, or you see 2, 3, or 4 questions trying to teach you about management integrity being a preclusion to taking an engagement, or whatever the case may be. You see these things multiple times throughout the questions and you know they are important, so you take the time to write them down in your own words as pillar topics, the most important things you need to know for the exam. And as you do this each day, you're building your own personal repository in your own words of, again, the most important things you need to know for the exam. And that will make it so that by test day, you are much more prepared. With that, let's go to the pillar topics for this video. All right, here we are at the pillar topics. Let's go ahead and just dive into them. First off, management integrity. Management's honesty and ethical behavior are critical in deciding whether to accept or continue an audit engagement. A history of intentional misstatements or refusal to share critical information indicates a lack of integrity that often leads auditors to decline the engagement. If management has a history of poor integrity, then that should be a big reason for auditors to not take an engagement. Scope limitations. Any client-imposed restrictions that prevent the auditor from accessing necessary information is a significant red flag. Major scope limitations can preclude forming an opinion and justify declining an engagement. Again, if they are going to stop you from having certain information that you need to perform the audit, then that is a big red flag. You should be aware of that. That would be a scope limitation. Let's also talk about sufficient appropriate evidence. This was kind of linked to the scope limitation when we talked about it in question 2. Auditors must determine if they can obtain enough reliable evidence to support an opinion on the financial statements. Missing records, restricted access to key accounts, or inadequate documentation can make an audit infeasible. If you don't have access to evidence, whether that's because of scope limitation or because it's just not there or it's poorly recorded, then that would be a reason to also not take the engagement potentially. Now let's talk about predecessor-successor communication. Successor auditors must attempt to communicate with the predecessor to learn about key risks, disagreements, and management integrity. If the client denies permission for this communication, the successor auditor should strongly consider declining the engagement. Again, if the client isn't going to let you talk to the predecessor auditor about the predecessor auditor's engagement or prior audit, then that's a big red flag as well. Now let's talk about integrity and also weak controls. There was kind of a distinction that was in the question, so I want to talk about that. Weak internal controls increase audit risk, but don't automatically prevent engagement acceptance. These can often be addressed with additional procedures. By contrast, demonstrated integrity problems or deliberate misstatements by management typically lead auditors to decline the engagement. So there is a difference there. Weak internal controls doesn't necessarily mean that management is lacking integrity or anything like that. It might just mean that they haven't thought of good internal controls. So they might need help with during the audit, once you point that out. By contrast, again, if management lacks integrity and they are doing things to purposefully misstate things or purposefully hide things, that is something that is a no-go. You don't want to have that. So you are going to avoid that audit engagement. Now with that, we've talked about the pillar topics and we've gone over the first 5 questions, and that is the end of the YouTube version of this video. Remember, SuperfastCPA Pro members are going to get access to the full 10-question version that I'm about to finish after I finish recording this part. So if you like this and you like our other products, remember, you can get the full 10-question versions of the videos by becoming a SuperfastCPA Pro member. They will be in the Pro forum. Now with all that, one more thing I want to remind you of, make sure you check out the SuperfastCPA training webinar on superfastcpa.com. It's 1 hour, it is free, and we will teach you the key ingredients to passing the CPA exam, and that will be a great path to you figuring out how to become a SuperfastCPA Pro member. With all that, I hope you liked the video. I hope it was helpful. If you did like the video, make sure to like it and leave a comment. Thank you for watching, and I will see you in the next video.